let's get in our market master for today. We have Venugopal Manghat. He's joining us to take some questions. Venugopal, of course, is Chief Investment Officer, Equity at HSBC Mutual Fund. Venugopal, great to have you with us here. Good morning. Prashant this side. We spoke recently, and of course, I mean, even from there, markets have come off very sharply. Yes. It's just been a one-way slide. Broader markets, of course, still looking pretty weak. You know, we had Gautam Dugat of Motilal Oswal yesterday with us, and we were just comparing long-term, what does the small cap and the mid cap indices at the index level trade relative to the Nifty and where they are now. So going by historical sort of gaps, it would seem that both the small cap and mid caps at an index level still hugely overvalued. If you just go and look at history, 20-year histories. Just your thoughts to begin this conversation there.
Yes, good morning, Prashant, and thank you for having me on the show. Yes, I think from a historic perspective, small and mid caps still look a little expensive, but I wouldn't say that it's just the small caps and mid caps that are expensive today. I think many of the large caps, including the IT names that you were speaking about just 10 minutes ago, and maybe even many of the other names, consumer names, are still expensive. So I don't think it's only the small and mid caps. The other thing that I would want to say is that we are in a structural expansion for the economy, and given the reforms of the last decade, I think the platform is set for the smaller companies to really grow much faster. And in that sense, for the next 7 years, as the economy is expected to double in terms of size from a 3.8 trillion to a 7 trillion plus by 2030, the landscape of the market is likely to change drastically. And by 2030, I would think that some of these small companies, especially in the discretionary space, discretionary consumption space, manufacturing space, etc., would multiply significantly over the next 7 years. So that's where the money is likely to be made. Even though the valuations look a little expensive as of now, that's the case across the markets, and you're seeing the correction therefore. So I think this is a healthy correction. We've already seen more than a 20 to 23% correction in the small cap index. Stocks have corrected 30 to 50%. I think that's a fairly strong correction in a good expansion cycle. My sense is we are getting close to the bottom. I think it's a good time to invest, much better than what it was maybe 6 months ago.
The high was made in September, so it's been quite a fall over the last couple of months, but we're closer now to the bottom. So at these levels, if one needs to construct their portfolio, tell us top down, how much would you allocate to financials? Because I see recently HSBC also launched a financial services fund. So how much would go into banks, NBFCs? Is that a space that looks attractive? Insurance? Make a portfolio for us if you have 100 rupees of incremental money to put to use right now.
Yeah, across the market, if I have to look at sectors, I think consumer discretionary is a space which is, like I just mentioned, is I think bottoming out. So many of the stocks that we were looking for, to invest over the long term, for a long period of time, are now coming to a reasonable level. We believe the interest rate cuts and the SOPs that have been given to consumers should benefit over a period of time. With a lag, it should improve consumption trends. And therefore, that's a good segment to be in for the longer term. Of course, I'm talking about the next 3 to 5 years or even more, because we are long-term investors, and I think the opportunity is to invest for the next 5-7 years. Similarly, I mean, we've launched the financial services product. We believe strongly that the non-lending space is likely to expand significantly. The number of companies today you see in the market in the listed space within the non-lending part of the market is limited today, but I think over time that is going to increase. We've drawn parallels with what happened in the US market from the 1980s till now. The US GDP grew about 10 times from 1980. It was about $2.8 trillion in size. Today, it's more than $28 trillion. And during the same period, the financial assets have grown within the country, has grown more than 20 times. And we looked at the non-lending part of the S&P 500, the top 15 companies, and we found that those have grown in terms of market caps very significantly over the last 25 years in this century. Drawing parallels from that, I think we are in the starting phase of an expansion in that non-lending part. So I would definitely want to allocate money there for the longer term. Of course, stocks are correcting there. In the near term, I would agree with many others in saying that the banking space looks a little more attractive in terms of valuations. But there again, I think there are points that you need to consider before really taking a longer term view, given that the net interest margins are probably at a peak, and the asset cycle is at its the best in a long time, and credit growth is yet to pick up in a big way. So till the time you have confidence on the private capex cycle, I think credit growth is likely to remain sluggish, and the retail growth is also the regulatory pressures are there to not grow it beyond the point. So in that sense, I think credit growth will continue to remain sluggish for some time, and the NIMs and asset quality is at the best. So I don't think you can really say that they are structurally, therefore, very attractively priced. But on a relative basis, yes, that's a space that looks better in terms of valuation.
Hi, Venugopal, and good to see you this morning. The other point from the banking as well as the financial names is the FI's largest holding is in these names. And they have been selling lock, stock and barrel. You thought 2024 was bad. Well, just take a look at the start of 2025. What's your view on this FI selling that we have seen? One would argue their holding is at the lowest we've seen in multiple years, but it's just not stopping. Yesterday, we saw closer to $1 billion in a single trading session. Your take on this?
Yeah, I think the foreign institutional flows have gone against India and possibly against the emerging markets from September end. I think that's when the market started building in the expectations of Mr. Trump coming to White House. And I think with those expectations, the dollar index started gaining, the bond yield started moving up in the US, expecting inflationary pressures with tariffs and retaliatory tariffs. All of that, to my mind, has played out. And in this period, I think China has also been trying to revive and recover to some extent. I think there are some positive spaces there, and valuations are definitely more attractive against most other countries. In this period, we've also seen the Magnificent Seven in the US really put more money into AI and a lot of noise around that, and that driving markets further. So I think against a slowdown in India and high valuations, probably the foreign investors are seeing better trends outside, maybe a stronger growth market in the US, maybe value in China, maybe some safe haven assets outside that. So that's probably what is playing out. My sense is the brunt of selling, or the larger part of the selling, is probably done. I don't think the ferocity with which the selling took place over the last 3 or 4 months will continue going forward into 2025. I think at some point, and my belief is the markets are likely to bottom out soon. And at some point, the foreign institutional investors, given that they are so underweight against the index, will need to relook at India.
You did mention the US, etc., Venugopal. So my question essentially is, do you think the top is in for US tech, simply, and if it is in and we see meaningful pullbacks, will it have an impact here in India?
I'm not an expert on the tech sector, but I think what I'm hearing from a lot of strategists also is that the spending that has gone into the IT space, especially for AI, has really peaked and is extraordinary. And it may not result in the results that one is seeking. And to that extent, I think there could be challenges for that space. My sense is the valuations also overheated there, and very sooner than later, I think that market is also likely to peak out, in my view. But it all remains to be seen as to how the Trump administration takes this forward, and without challenging inflation, or without stoking inflation and or impacting the growth in the economy, does what he wants to. The IT space, however, I think the AI is clearly the next wave that we are seeing across the world. So it will continue to be a buzzing space. The stocks there have become expensive and have done extremely well. So maybe you could see a peak soon.
All right, Venugopal, thank you very much for joining in.